Today's talking point. I'm your host, Neeraj Shah. A bunch of things happening around the markets which might cause, skepticism in the mind of the bulls, but the markets continue their merry run unabated. We're up nearly percent in today's session, and I think the talking points today will be centered around what does our guest believe is in store in the near to the medium term, as opposed to always talking about the long term. Though he's a long term investor, he runs the equity book of Aditya Birla Sun Life AMC. Mahesh Patil joins us right now on the show. Mahesh, great having you. Thanks for taking the time out. Hope all is well.
Yeah, all fine. Yeah, good morning, Neeraj.
And all fine for the markets as well, Mahesh. The merry run continues. The question is, there are a number of indicators, including Warren Buffett sitting on large swaths of cash, which might make one wonder as to the extent of this up move and how much can it continue. What is your thought about the current run that we've seen and this inherent strength that we see in the Indian markets?
Yeah, so I think last 1 month has been particularly good. I think after the initial sell-off, what we saw from FIs in the initial part of this calendar year, I think that has now slowed down. In fact, we've seen some buying. I think now the valuation differential which was there vis-a-vis India and the other emerging markets, especially the Asian markets, that has narrowed down because other markets rallied and India underperformed in that period. So I think that selling is behind. So that's one lift to the market really. But I think overall, I think globally we have seen that both the US and other markets have also done fairly well, both the US and the European markets, where actually there is a concern about growth slowing down or recession coming in. And the reason for that could be that most of the negatives are now kind of priced in, though I don't think there's any reason for us to be, at least in the global markets, to be immediately bullish. But I think the rates have peaked out clearly after the last Fed policy. It is pretty clear that you've seen the last of the rate hike cycle. And while rates might not come down in a hurry is what we believe, but I think market is starting to believe that you might see the pivot in this whole stance by the Fed sometime later in this calendar year. And inflation is also coming down, though it's still slightly sticky. So all in all, I think at least the concerns about where the market is kind of bottoming out, I think that is behind us. I think market clearly has bottomed out, and the low what we saw a few months back, I think that should probably hold on. And then it looks really from here looking forward, while in the near to medium term, at least on the global front, nothing really exciting, for the market to really propel up. But on the domestic side, I would say that numbers have been fairly decent. We've seen the fourth quarter numbers come in, and by and large, it's been a decent performance. There have been some hits and misses, but by and large, we haven't seen anything major to be worried about. And the overall earnings growth trajectory, we will end probably fiscal 23 at around close to around 13%, 14% growth. And next year also we're expecting around 12-13% growth, which is not bad in the current context. And I think that's the reason why the markets have actually, after some period of relative underperformance, I think we just try to catch up over there. And yeah, I don't think the market should, we should see a big rally, or because earnings growth is going to be slightly muted this year. But overall, I think the sentiments and the sectors, if you look at domestic facing sectors, they are looking reasonably well, especially sectors like banks, came in with good numbers, which is a large sector. And global sectors also, right, like IT sector, while there have been some downgrades to it, again has been a mixed bag. And despite that, I think in the IT sector, if you look at the earnings growth next year, this year, FY24, we'll still be around 10% or so, at least the bottom line, which is not bad in this context where you're seeing major concerns on global growth.
So the question, Mahesh, that might come in that if indeed the earnings don't grow at, let's say, the consensus of 16-18%, but grow between 12 to 14%, hypothetically, let's say, for the markets at large in FY24, then we are actually not trading at about 19.5. We're trading much higher than that. So is that valuation justified, considering the point that you made that the world is starved of growth, and therefore whatever shows growth will trade at that premium? Or should one look at history and say that, hey, look at the normal valuations versus the current deviation, and therefore pay for the mean and don't pay a premium?
Yeah, so that's a very difficult question to answer because how the market behave. If you look at in the US also, right, developed markets in the last whatever 5-6 years, we have seen US market has traded at a premium to its historical because growth in the US developed markets was much stronger than the other emerging markets. And now we are seeing that the concerns are more in the developed markets, right? Emerging markets, by and large, should do relatively better. So, given that, I would presume that India's growth differential now starts to look much better, and even compared to the other emerging markets, I would say, the Asian markets. While this year and China and other markets could do slightly better, at least on the economy side, but I think they're not likely to sustain that. So, I would say that India, given the fact that the growth differential is now much better, can trade at a slight premium, and it's a question about liquidity also, right? So, we've seen that FIs at the margin are starting to turn, flows have turned positive. Domestic flows have been fairly strong and steady, despite the fact that last 18 months the markets hasn't gone anywhere. The FI flows and domestic flows have been fairly steady. So that inflow of money which is coming in will ensure that the markets, you won't, the premium, okay, could be because there's probably more cheap money chasing, okay, than the supply which is there at this point in time. So I would not be too worried about slightly premium valuation, the long-term average. I think the more important is the trajectory of growth and direction. I think markets look to be on a fairly, reasonably good outlook, at least from say the medium-term perspective. I think the only reason for us to be worried about in the next 1 year would be or rather, some volatility could be around the general elections, okay, which are there later, because I think it's important in Indian context that you have that stability so that the whole reforms process and the momentum which has been there, okay, it continues. And stability on the political side would be important from that perspective.
Okay. Mahesh, could it be a scenario? I'm just trying to understand. And would you be happy with that scenario if, because of this pulls and pressures, the benchmark indices don't deviate too much? They've done a little bit of a move from those lows of 16,800 to whatever, 18,100, 200 circa where we are currently. And from here on, maybe the large stocks and the Nifty doesn't move too much. But if it stays stable and the broader markets on sectors which are performing really get a fillip, would you be happy with that kind of scenario? Do you think that's a possibility too?
So, yeah, I think we've seen the breadth of the market has improved, okay, recently. Yeah, so which is a good sign. So you're seeing not just the large benchmark weight stocks doing well, but others also catching up, and that's always a good sign. At least I would like that, because as a money manager, because that gives you opportunity to build a portfolio which can outperform the benchmark, and that's been a kind of a challenge for most active fund managers in the last 4 years or last 5 years. So beating the benchmark has been a tall order, because at times the market breadth has been narrow. A few large benchmark stocks have really outperformed. But I think the scenario, if you're talking about it, that's what we're seeing currently, pan out now again moving back to the stock level. I think it's a good time for money managers to really pick up a portfolio, build a portfolio bottom up, and then try to beat the benchmark by a reasonable margin.
Okay. In which case, Mahesh, I know you spoke about banks being that key pocket, great results, very likely could do well, but I think everybody's baked in or invested in that space per se. Where is it that you, and I'm guessing it's a bottom-up story, so, and we obviously won't talk stocks. I'm just trying to think, what are the themes that are finding favor? 2022 saw PSU banks, saw defense, saw the re-emergence of auto and auto anchs, which you guys had pointed out back in 2022 start, right? And it did very well for you. 2023 or FY24, if I can use that term, because it's the start of that year, so to say. Where is it that you are fishing in?
So this year, again, I think within the financials, I think the NBFCs, okay, could probably slightly do better than what they did last year, because as rates have peaked out and rates probably come down, you will see the NIM expansion in NBFC, which you have seen in the banks, okay, in the last few quarters.
Got it.
So that could be one slight shift within the whole banking and financial services space, where you could see that shift there moving in. Apart from that, I think it will still be focused on the domestic sector. So I think consumption is where I think one would be positive, because while rural is still picking up, it's not like doing very well. But as we move forward in the year, I think we believe that during the election year, I think you will see some kind of a boost to consumption. I think latter part of this fiscal year, and in the current environment where there are some challenges of growth global, I think consumption sector, which probably looks to be much steady, and I think that could do well. Within that, I think discretionary consumption is where one would try to build the portfolio. If I'm taking a say 2 to 3 year view, because there has been some slowdown there. We've seen correction in the consumer discretionary names in the last 1 or 2 quarters, and this would obviously be a slightly higher growth sector than the normal staples. And in India, structurally is poised for better growth, where discretionary consumption as a part of the total consumption will steadily increase as per capita income goes up, as premiumization happens. So I think that would be a sector where structurally will be positive, and in this current weak environment could be a good time to look at it if from a 3 year perspective. Apart from that, sector like pharma, for example, as a defensive, which underperformed last year, okay, because coming out of the COVID, the base was very high. I think that is now normalizing. Even in the export front of the US generics market, we're seeing some kind of, the pressure which was there on the pricing has kind of slightly abated, and there's some amount of consolidation, okay, which is happening, which is good news. And domestic growth should be steady. So pharmaceutical, healthcare would be again good defensives. Okay, to look at valuations also not too expensive, near the long-term average. And then finally, to play the domestic cyclical, I think the industrials, the capital investments related stocks will also do well, because we are now kind of getting into a kind of a beginning of our private capex cycle. Still early. It might take another 9 to 12 months before you see momentum over there, but that's where I think you would see the delta change happening.
Mahesh, just on that last point, are starting valuations a bit of a hindrance there on cap goods? I mean, we spoke to ABB recently, very confident about the order inflow, etc. But for most names, aren't starting valuations a bit of a hindrance?
Yes, you're right there. So starting valuations are of a hindrance, and they are, significantly higher than in absolute vis-a-vis their long-term averages. And yeah, and the sector is not like there could be some challenges also there. Depending on how the whole, as I said, elections and this thing would be also important for us to get a long-term visibility on how the capex cycle pans out. So you're right. Broad top down, it looks good. Valuations are to large extent factoring. So margin of safety is low. So we are slightly careful, not really aggressive, but trying to pick pockets over there where you could see surprises, or rather positive surprises, where it's still not factored in. But yeah, large extent, it's priced more than priced in few of the large names.
Okay. I have a last couple of questions. One is on a space and one is then on the mental model of yours. So over the next 12 months. First, the space. The way you're talking about cap goods, for example, could defense be clubbed in the same bucket? A sector of the year for 2022 has seen some hiccups or divergent moves between participants 2023. Were you bullish then? Are you still bullish now? If yes, then why? If no, then why not?
So defense, we have been positive again on that name, because while the overall defense budget hasn't really increased much, it's more about localization which is happening, right? Government has a resolve to increase domestic sourcing rather than from exports, and that's driving growth over there. And I think that continues, okay, over there going forward. Again, in that sector, we have seen a recent outperformance and re-rating of a lot of these defense, mainly in the PSU space, right? So I think it still looks steady, but again, I think the re-rating which we saw, I think that's likely to be behind us. So we're not expecting any large outperformance or further re-rating. I think a lot of the order inflows, again, these are some of the projects have very long gestation period. So you got to be patient, right? It won't probably necessarily reflect in terms of growth in the immediate short term. But so long term still positive, but I think to a large extent now pricing, we don't see any big upgrades there coming in.
Got it.
So, but yeah, I think that will be a whole part of the whole investment cycle. I think for the capex infrastructure cycle, I think the industrial capital good. I think defense would be a part of that.
Okay, Mahesh, my final question. Twice in this conversation already, you've cited about the election verdict and how important it could be to multiple themes and maybe for the stability at large. So my question to you is, how do you navigate through the next 12 months? We are almost at the point of time where in 12 months out, we'll have the election results. But the next 12 months will be peppered with state election verdict, one of which we'll get in the next few days, as also multiple opinion polls and whatnot, news flow. So how does a large money manager like you navigate through the next 12 months? What's the mental model?
So I think in this scenario, I think you should be not only domestic, but externally also there will be some risks, okay, which are there. So you have to be careful in terms of your stock selection. Again, looking at margin of safety when you're buying stocks. At times we've seen certain stocks move up because of liquidity. So just not getting carried away, not being too aggressive, focusing on fundamentals, trying to really look at more bottom up, I would say. At this point in time, top-down call on the market, I think in this kind of a certainty is a bit difficult. You will not get it right always. Just stick to fundamentals, focus on bottom-up stock ideas, look at companies where there is lesser volatility in earnings because of external factors, domestic factors. I think that's where the focus would be, and not try to dilute on the quality side. Okay, again, that's also equally important because that will hold up in case there is a market volatility or some kind of correction. So I think we try to be more balanced, not to be aggressive, looking at margin of safety, more bottom up. I think that's the approach, I think, which I would take, at least looking at the domestic as well as the macro environment.
Got it. Mahesh, thank you so much for your time today. Lovely talking to you and all the best for the quarters ahead.
Thank you, Neeraj.
And viewers, thanks for tuning into this edition of The Talking Point.